The spotlight remains on the South African economy amid global and domestic risks. On the local front, economic growth is a major concern, particularly after the 1.3% contraction in gross domestic product, along with ongoing impact of the electricity outages. Global factors, on the other hand, remain inflation, rising interest rates and geopolitics. To expand on this and an economic outlook for this year, we are joined by investment executive at Foord Asset Management, Eedes. Linda, thank you so much for your time. I think let's start with inflation because it really has come back under the spotlight both globally and domestically. What's the outlook there?
Hi, Tumisang, and thanks for having me on the show. Yes, inflation is the starting point for a lot of the economic risks that we're concerned about, both globally and locally. Of course, we've seen inflation come back quite strongly in the global situation. Here locally, we've lived with inflation for quite some time. But yes, we're starting to see the worries that inflation, even though it has peaked in areas such as the US, that it's not coming back down to the levels that the central banks would like. And that has serious implications for where interest rates go and the knock-on effect for, of course, economies like ourselves that are very dependent on the global economic cycle.
On the local front, what then is the expected impact, particularly on consumers? We've seen food inflation is also not abating.
Absolutely. Unfortunately, we do think that inflation is going to continue to remain an issue. Also not helped by the fact that with the US interest rate cycle not finished, in other words, there'll probably be further rate hikes there, we will see probably the South African Reserve Bank having to follow suit. Even though from an economic perspective, as you rightly pointed out, last week we saw a contraction. We're probably going to see another contraction this quarter, which means that we're probably already in a technical recession. But unfortunately, we have to follow the global interest rate cycle, and partly to defend our currency. The more that the US raises interest rates, the less desirable the rand becomes relative to the dollar. And we've seen the currency depreciate quite significantly already. So unfortunately, inflation, although it may have peaked, is unlikely to come back down to the levels that we'd like to see in that sort of inflation targeting range.
We've also seen the US Fed come out quite hawkish in terms of their stance in fighting inflation and rising interest rates. It's maybe a foregone conclusion that the South African Reserve Bank is going to follow suit, but what else is going to form part of the upcoming Monetary Policy Committee meeting, particularly for this period after that contraction in the South African economy, Linda?
Well, I think we are facing a myriad of challenges. In South Africa, the other risk that we speak about, outside of the fact that inflation and interest rate risk remains very much a prominent concern for all investors, I think, around the world, not only here in South Africa. You have that impact of inflation coming through, particularly given that we have a government which has a debt problem and a spending problem. So economic growth has been very muted. We've seen only sort of 1% real growth, so 1% above inflation per year in South Africa for the last 10 years. That's a major issue. Investors want to see much higher economic growth coming out of emerging markets. So it's likely that the environment will remain tricky, both for investors but also for consumers on the street. So it is still a time to buckle down and be careful and sort of focus on spending on the need to haves, unfortunately, rather than the nice to haves.
Speaking of South Africa's debt then, how does government navigate spending as well as being prudent during this time?
Well, the best thing that they could do is actually create a climate that is more stable from a political perspective. And of course, we're going into quite a transition year ahead of the elections next year. We've seen quite a lot of changes. Some of those, one could say, are moving in the right direction. But the reality is that we have a very unstable backdrop. And that isn't very good with regards to encouraging economic growth. So the best thing that we could do is actually create an environment which actually allows economic growth. But whilst we are still getting there, I think probably the only likely reason or likely outcome is that some inflation, whilst it's not good for consumers, actually helps government's debt problem, because debt is looked at as a percentage of GDP or the economic output of the whole country, and that's measured in nominal terms. So if you have inflation, that number actually rises, and the debt to GDP, because you've got a denominator that's going up, actually comes down. So that's one way that the government could kind of use inflation to their advantage. But the reality is that we do need to rein in our debt, and that's becoming more of a challenge as the government has to obviously take on debt for the likes of Eskom, and we know that the other SOEs are also in difficulty. But from a debt perspective, we really need to get that under control. At the moment, almost a fifth of the revenue that South Africa generates or the government collects is actually going just to servicing that debt. So in other words, just paying the interest on that debt. And of course, that spending that could go to education and healthcare and essential services, which could actually help South Africa over the long term.
Thank you for your contribution. Linda Eedes is with the Foord Asset Management, talking to us about the remaining risks in the South African economy, as well as the global dynamics around that.